All right, Jill, will you give us a few background notes about you and the exciting things you're working on?
Yeah, happy to. Well, first of all, thank you, Kate and Rachel, for hosting us for the conversation and excited to talk to you all today. Um, I'm Jill. I'm a principal at Rethink Impact, which is a venture capital fund focused on female founders across four sectors, one of which is sustainability. The other three are also mission aligned: education, health, and economic empowerment. We're classic venture capital investors. We invest in tech companies, mostly B2B and B2G that we think, are going to scale to become really big, 100, $200 million companies. And in that way, create impact in two ways. The first is, obviously through the normal ways you think about sustainability, reduction in emissions, kind of increase in circularity, but also to create wealth for the female founders who are actually building those businesses through hopefully very successful exits. Um, I've been here for about a year and a half. I've actually been an investor across multiple asset classes. Prior to this, I was a vice president at Goldman Sachs' Urban Investment Group, focused on economic development as well as sustainability investments in equity, debt, and tax credits. And, happy to talk about this later on, but climate and sustainability is one of those sectors where it is really important to have kind of multiple types of capital and to kind of match the returns you're looking for across the risk spectrum and kind of match the type of capital with the type of business that you're building. So I've been an investor for about 5 years. I was a Wharton MBA, as well as public policy dual degree, and just kind of really thrilled to have this conversation with you all today.
Awesome. Thanks, Jill. Kim, could you give a brief intro as well?
Sure, absolutely. My name is Kim Kolt. I'm the founder of Baybridge Ventures, which is a early stage venture capital fund focused on climate. We have three partners between us, and we're founded really upon the thesis that the most important technologies of the future have to solve critical problems for the environment and thus for humanity as well. Before that, I started For Good Ventures, which I started after leaving Goldman Sachs. I was in the technology investment banking group and got to see a lot of fast scaling software and internet companies and help with the later stage rounds. That was based in San Francisco and Los Angeles. Before that, I was at Wharton and MBA, and also my background was in kind of traditional finance and more investment banking across a number of different sectors. So that really helped to situate me to be in a good place for venture capital in general, getting to see how a lot of different industries worked. And it was at that time I also got my lead certification in new construction to help with my family who's in hotels, resorts, and transportation. I was very interested in reducing the footprint as much as possible for those physical developments in the built environment. So Baybridge Ventures is kind of a culmination of all of those things now coming together.
Wonderful, wonderful. Maybe my first question, I'll start with you, Kim, is what motivated you to take the leap to start For Good Ventures after leaving Goldman Sachs and the larger institutions?
I think there was always a disparity between what I had hoped to do on my personal time and what I was doing in my professional time. Not that I didn't enjoy both, but I didn't see a way where I could ultimately add a lot of value into the causes that I cared deeply about initially. And it was actually I'm candid about the fact that it was the passing of my father, who was probably the closest person in my life. And then that really emphasized what I really wanted to focus on the most. And growing up in Hawaii, it's really difficult to separate yourself from nature. I think you can't see your existence apart from it when you are very much one and the same with it. And that kind of philosophy just made me feel like that was the most important thing. And our reliance on the environment was really paramount to all of our health and basically everything else that we build and live on. Um, so it the question that I asked myself was, how can I add the most value to these different causes with the skill set that I had? And I really felt that that was through venture capital, through adding value to young founders who were spin-outs of universities and technologies that maybe didn't necessarily have the experience in business and creating the right capital structures and governance over time. And so just really stepping in to help them and figured that that was something I loved and really built a whole firm with multiple investing strategies off of that original thesis and really where I could feel my own value being needed in that space. So
And then just fast forwarding, thank you for sharing that. Hawaii is so magical. I could have a whole year conversation on that. But and then from For Good Ventures to Bay Bridge Ventures, what was the thought process there and your leap of faith?
it was my two amazing partners. I started working with them during the pandemic. We had very similar theses, but different skill sets. One partner, Joe Blair, is just a brilliant engineer. He and I had worked together on a number of climate tech deals, deep tech. When he was with Obvious Ventures, we knew that we wanted to work together. And likewise, my other partner comes from an institutional investing background. After many years of investment banking, he joined CalPERS and was the head of their direct investments, controlled a $15 billion portfolio. And he just had a very different skill set and relationships than we did. And coming together, working with people that you really care about every day and that have the same values but different perspectives and different backgrounds were it was really exciting. I was actually looking at investing in them because For Good Ventures has backed a number of firms, emerging managers and established strategies as well. And working with them was something that was such a highlight. I knew I wanted them to be my full-time partner. So I kind of joined as a third partner, and that was several years ago now.
That's super exciting. What a story. Speaking of passion and commitment, Jill, I know you're very passionate about closing the systematic gap between capital opportunity. Could you talk a bit about the initiatives that you led at Goldman, but also today at Rethink?
Yeah, let me start with Golden because it was a bit of a unexpected, I guess, path for me when I left my MBA. I'd always been very focused, I will say, this conversation's about sustainability. I'd always been more focused on the human capital side prior to business school, a lot around education, jobs, and community. And when I joined this group, the Urban Investment Group at Goldman, it was this mix of things. It was like partially real estate and affordable housing, partially public-private partnerships, small business lending, student lending. It was kind of a big mix of things. And I didn't really have experience in any of that in project finance and real estate. I mean, I'd never been an investor before. And what I really wanted to do was join a group that had enough in the way of capital and enough kind of institutional leverage to be able to create better communities for people, which I really believed was the kind of thing that, made a better life possible. And when I joined that group and started working on, I'll just kind of give some examples of the real estate projects just here in New York. There are actually an incredible number of incentives, tax incentives, grants, kind of subsidized debt available for housing developments that have green features to them. So that might be like geothermal energy or solar tax credits, obviously higher leads ratings. The thing is that a lot of that isn't actually available or accessible to everyday investors. Like you and I, if we're kind of putting money into housing, it's actually really difficult to access a lot of that. It takes just a lot of transaction fees. It takes kind of finance experts and tax experts and lawyers and all of these other things. And I didn't realize that that entire ecosystem even existed until I joined this group that actually had all of those resources to be able um, to gather it all together, to gather housing with sustainability, with economic development, kind of small business access in one place. And I felt that, this is probably not exactly your question, but as an investor, at an institutional level, I was able to pull all those resources together and create something in a community that I think even as someone who came from, I was a consultant before, I'd been in finance, I did my MBA, I didn't even realize that all those things existed to advance sustainability goals. Um, and I really loved that. Like I loved being able to do a project where you could pull in public sector incentives with different kinds of financing, debt and equity, and tax credits together, and create really cool projects. And those developments, exist in the Bronx, in Upper Manhattan, kind of down in Queens, and it's really amazing to be able to see that better. I
Yeah.
think when I thought about my next move and going to Rethink Impact, the thing that I was looking to do is to take some of that innovation and scale it even faster. So, obviously being part of a big institution means that you have a lot of access to capital, but there's only so much risk you can take in terms of innovation and only so much speed, I guess, you can pursue because of all of the other bureaucratic structures that exist. And so a lot of the things that we look at in our kind of sustainability vertical here at Rethink Impact are focused on tech solutions because those are the ones that, we think can scale really quickly and can take some of I guess the complex structures and the things that are hard for individuals to pursue themselves, and to create something really big out of them. And, I'm sure we'll get into kind of specific investments later in this conversation. But, we do everything from food and agriculture to buildings and the built environment, energy, carbon removal, kind of operating efficiency and industrial efficiency as well. I would say everything within sustainability. Is open to us. And what's, really cool is that we get to hopefully take something that maybe someone really small is doing today and scale that to a much larger population and therefore create, more sustainable impact, but also, again, more kind of wealth and just opportunity for everybody that's involved in it.
Jill, for you, at what stage of companies do you look at? Is there a range?
Yeah, we invest in late seed to Series C companies. So that's really early to mid stage venture investments, which means that usually the company already has some source of revenue. If it's a deeper tech company, then it means that usually they have commercialized in some way already, but they're really at an inflection point of growth. So, they have some customers, they have contracts, but they haven't necessarily poured on the fuel of sales and marketing dollars to really kind of push that growth to something much, much bigger. Usually like 1 million to 15 million in revenue is where we
Oh,
start
gotcha.
investing.
And Kim, what about you? At what stage do the companies need to be for you to have a meaningful conversation?
It's nearly exactly the same, actually. We look for 1 million or more in contracted revenue. We like to see that product market fit. That's really the sweet spot for us for our fund. That being said, we've also invested a little bit later stage as well, in Series B and have put together a number of SPVs as well for our investors in those areas. So it's very similar. We like we in terms of our due diligence, we focus a lot on customer reference calls, and that's something for us to really understand. Is that technology or product truly needed, versus just desired? And how much it's needed and how much traction and kind of the land and expand strategy, because we do focus on B2B versus B2C. So that's one of our essential components there. I will say that all three partners, we are actively engaged in earlier stage, even though we don't invest until we see that product market fit. We're advisors or judges or on boards of various universities or accelerator programs or nonprofit programs. And so that is near and dear to all of our hearts. And we also try to see those companies early and maintain relationships with them over time so that they do come to us when they're in the sweet spot for our fund.
That's wonderful. So, in the earlier stages, and I know Jill and you too, Kim, we talked a little bit about government funding. What is your view on grants today, non-dilutive funding? How do you look at that when it comes to you through a company?
Yeah, I can start. I know Kate and I had a healthy discussion about this previously. I would say just as an overarching point, Non-dilutive funding is great. You can get it in general because like venture capital is a very expensive form of capital. It's actually probably the most expensive form of capital that's out there. And there are specific ways in which it's really great to have because it's extremely flexible and can allow you to scale very quickly. But non-dilutive sources of funding for founders in particular, I would definitely advocate for. The um, kind of thing that I think about, I will say, is that non-dilutive and grant funding should be a catalyst. It should be funding, in my mind, that allows you to innovate with a lower amount of risk and to build a product and to kind of get out the kinks in the business model, I would say, before you're looking to scale up. I would say that grant funding, especially in today's environment, and I'll say in today's political environment, is much harder to rely on as a recurring source of revenue. And that is something that investors, but especially investors who are looking for a little bit of commercial traction already, will tend to test and kind of think about. So, for example, if a company has 5 million in revenue this year, but 4 million of that came from a grant, that's a one-time grant, it's really hard to say that you'll get that 5 million or even grow to 7 or 8 million next year because that grant may or may not exist, even if it's meant to be kind of a recurring source of funding. Like, goodness knows what will be funded next year and what will be funded the year after. And so I think when it comes to looking at that source of funding, I always say get it to start up the business, to de-risk, to really figure out what you're building. Um, but when it comes to thinking about a sustainable long-term business model, I would almost separate that portion out and say, what things can I fund via grants and what are my other sources of revenue that I can rely on regardless of the political environment. Um, there are, just as a caveat, I would say a few types of businesses where that may or may not be true. For example, if you're the kind of business that relies on huge defense contracts, that will always be, a government contract, but that in my mind is different from grant funding, which is more kind of one-time startup funding that companies can access.
Yeah, for sure. And if I can just add, I've written so many grant applications, and I know Kim, you help startups advise them on their grant applications as well. But the way grants work is they basically give you money, but you have to show that you've spent the money once you're in the award for the most part. And so it to Jill's point, it's not recurring because they might decide you don't qualify for the next round or the initiatives have changed and the buckets have changed. And so there's a lot of work in allocating budget costs and whatnot. Sometimes though grants are a distraction to maybe the company vision. Kim, do you have any experience on helping founders navigate that? So for instance, I'll give a personal example. We make graphitic anode, but we could also make hydrogen. And one of the grants we are working with wants us to prove out hydrogen. And so it's not a direct one of our primary objectives, but we do need the money and we do need to show traction. Um, have you seen how founders navigate that or any advice there?
I think grants are obviously incredibly important, and government grants in particular are a nice signal for a lot of the deep tech companies. It's not something that we, in our sweet spot, encounter too much more. We don't do a lot of CapEx heavy investing. We do see, where the IRA came in and some of the other government subsidies. We saw accelerations in our businesses, but we don't rely on grants or subsidies, government subsidies, for the underlying unit economics or growth trajectories of our companies. We've learned the hard way, right? We've all experienced Climate Tech 1.0, my partners and I, and have seen very quickly how industries can go from being able to get a lot of funding in the private markets and government funding to really not benefiting at all very quickly, and how it can really make or break businesses. So we from the beginning we've stayed away from that. That being said, I do speak every year for the Department of Energy, their SBIR, STTR grantees. I think the Department of Energy under the last administration did a really great job also of building out searchable databases and sharing their research for the private sector to be able to come in and rely on that. And get a kind of purview into the lens of the government's diligence. And that has really helped a lot of the deep tech companies. I actually say to many of those companies every year what Jill kind of echoed when she was speaking just previously. She mentioned that venture capital is the most expensive form of financing, and I always say that to those who are kind of going out of the grant phase, particularly government grants, and into the commercial markets. That if they can avoid venture capital, they probably should. And most climate tech businesses are not suitable for the venture capital duration or returns for the level of risk. And there are a lot of other forms of financing that have kind of come in to fill the market. We're at a particularly hard time right now, more so than ever. We're seeing, and I'm on the board of a couple of different climate nonprofits, two of the three of which have accelerators in climate tech. And I will say that right now we're very scared collectively about the pullback in grants and other forms of donations because of even the rumors themselves, despite executive orders ultimately being challenged and how they shake out, rumors themselves can cause a lot of disruption, and our donors have questions about, do they still get the tax deductible status? For example, will they be audited in the future? Should they be donating to climate when a lot of these solutions aren't going to get the continued support and, may not make it? Our argument is it's more important than ever to continue your funding, continue your commitment, and take a bold leap, right, into this space.
Yeah. Yeah, for sure. Thanks for putting that message out there. I did want to dive a bit deeper on if you can explain to the audience why certain timelines, especially the capital intensive ones, don't align to your timeline, what you're talking about there. And have you walked away from investments where the timing just didn't work?
Oh, absolutely. We're very careful about the durations that we take on for our fund for our investors. This isn't to say that we couldn't find a different capital structure that works outside of our fund, but our fund is venture capital first and foremost with a 10-year duration. And for that, you need certain scalability and unit economics. And for the scalability element, you can't rely on something that's going to take iterations of years between prototypes. Even with AI and digital twins and the software speeding that up, the large physical systems that generally are supporting industry or supporting climate, if you just look historically, even if you were to make significant speed ups in the assumptions of the iterations of those prototypes, it still takes, decades in most cases. And so it's not to say that there won't be many more Teslas, for example, but it's always important to remember that that took, hundreds of millions of dollars and a lot of government support before it could even be commercialized over several decades. Likewise, solar, right? If you look at these, so where we really focus is something that has a model that's more suited for high scalability and high returns. And generally that does include a software component, software enabled. We're not scared of hardware, but if there's a large real estate component, permitting processes, it's probably not right for our duration timeline. Yeah.
Yeah, for sure. I think it's actually hard to find a non-software component, even if you've had hardware.
Now, yeah,
Now,
I mean,
yeah.
generally you want the combination, but
Yeah. Well, you also need like system monitoring, diagnostics, all of that. Of Jill, what about you when you look at the more capital intensive investments? I believe you also focus more on the software, but where
Yeah.
is there a mix in your portfolio?
Yeah, we focus primarily on software. We have made software-enabled hardware investments in the past, whether it's, air quality monitoring, or carbon removal, which is a company we invested in last year. So we've definitely invested on occasion in deeper tech and sustainability, but I would definitely say our focus is on software as well. I would echo Kim's points on duration. In an 8 to 10 year fund with maybe 3 to 4 year investment period, you really have about 5 years to go from a company that looks like $2 to $5 million to a company that's $100 million and can, maybe even be larger than that and be ready for an IPO. And it's a really, really hard leap to make, especially if you're spending the first 2 to 3 years figuring out how to commercialize. So I would say it's less about um, for us, it's we pay a lot of attention to what point in a company's journey is the right point for us to come in. And the right point is when they are out about to kind of grow, I would say, fairly explosively and have figured out some of the kinks in at least their first product when it comes to go to market. In terms of the kind of CapEx intensity, we don't tend to invest in companies that have a lot of CapEx requirements, but all that said, if for whatever reason we feel that there is a pretty heavy CapEx component, those are situations in which, and I should say, and I didn't say in the beginning, that we both lead, co-lead and follow on in investment. So we do it all 50-50. A company with a really heavy CapEx component may be a situation where we're not the right sole lead, where we should co-lead or we should follow on with someone who has familiarity with kind of heavier CapEx investments and will continue to follow on round after round. Because we're a fairly sizable fund. We're
Yeah.
$260 million in this fund three, but we're not obviously in a position to be making $50 million investments in a company that may need that. So it's a little bit kind of correct timing for us. It's a bit kind of correct partnerships, and just making sure, we do a lot of evaluating, obviously, of the companies that we invest in, but we also think a lot about whether we are the right partner for a company at a specific time and at a specific moment in their journey. So it's, a bit of all those things together.
Yeah, it has to match. Actually, now I want to pin you and Kim against each other a little bit or together because you talked about co-leading or potentially a follow-on, informing, I'll call this a syndicate. When you're talking to other investors who are interested in investing in the same round, do you interview each other? How do you figure out if the syndicate works for you or whether it's finding another co-lead or finding someone to fill in the round? So for instance, if Rachel and I start a company and you're both talking to us separately and you're interested, and we bridge that gap and you guys start talking, what kind of questions do you ask each other? What
Yeah, I can start, but Kim, obviously, feel free to jump on. Where we're not the lead, if we're considering a participating check in a round, we'll almost always talk to the lead.
Mhm.
It's just important because that lead will almost always also have a board seat, be a really close advisor to the CEO and the whole founding team. Like that, the person who is the lead is actually quite important, I would say. So, having confidence in their underwriting and their diligence, kind of their alignment with the company executives is really, really important. Um, a couple things that we'll ask investors, and I will say that usually what you're trying to get from the lead investor is a little bit different from what you're trying to understand from the company CEO, because the CEO and the co-founding team is meant to kind of tell you more about the business. The things that we'll ask the lead might be like, what are your expectations for how this business exits? What did you underwrite to? Like what are the returns you're looking for and how do you think that'll be achieved? Is it M&A? Is it IPO? Do you see them as a plug-in to another kind of larger strategic? Like, what are your kind of aspirations and goals for this company? The second might be their interactions with the CEO and the founding team themselves. Because one thing just to keep in mind is that usually the lead investor will have had a lot more touch points, have just honestly spent more time with the founding team than some of the participating investors. And so it might just be a really frank conversation like, what are the strengths and, challenges of the founding team? Like, who do you think needs to be added to the team? What would you like to work with them on? And I say that because the lead investor, again, typically has a board seat and just is kind of in a lot of more of those conversations than a follow-on investor. And so I think as somebody who may not directly be at the table, it's important to get a lot of those answers from the lead investor. And those are the things that if we're the lead, will be asked as well. In addition to things like price and structure of the round and like the other investment stuff.
Makes sense.
Yeah, just to echo that, I would say we're of the mindset where we do really want a board seat or a board observer seat. Um, my partners and I have generally, we've been on a lot of early to late stage board seats over long periods of time and seen how important governance is. And so if you don't have a seat at the table and you're with the partner who's your co-lead or who is a lead if you're coming in as a follow-on investor is critically important. And our relationships with them, not just with the firm itself, but also with that partner, whether they're a junior or senior partner, matters a lot. I think learning the hard way is the best way to learn. And so many iterations of various patterns and themes over time allow you to identify adding value early when you have that governance seat. You have that, the board seat. So we do choose that. We also do a lot of technical diligence for other larger firms. That's something that, so usually when we come in, we've actually done a lot of technical diligence and diligence, even for firms that are much larger than us, and we go in alongside them. And they make sure that, that we're very much kind of tied in to the process. So we have close relationships. We've also, the three of us have invested in over 20 other climate funds in addition to kind of all being in the space for a long time. So the quality and maintenance and communication with the other investors, with the founders, identifying problems early, all of that is critically important. Yeah, board structure is another thing. We'll really target bringing in industry level expertise to come into those companies and add value from day one.
Wonderful. I have two kind of subjects I want to go through, and then I'll turn it over to Rachel for the Q&A. If everyone has questions, please put them in the chat. I know that'll help out Rachel a lot. Okay, speaking of the founding team, the CEO, how do you evaluate the founding team? I know both of you talked about filling in the gaps, talking about industry experts. What are some green flags, good flags, and then some, items of consideration when you meet the teams?
Yeah, Kim, do you want to start?
Sure, happy to. We actually did recently a poll of how long we've known our average founders
Mhm.
between the three partners of our investment portfolio. And in general, it's around 5 to 7 years, believe it or not. And I think that does say something to our level of expertise and comfort. We do a number of these folks are repeat founders, and they've been through the hurdle and we have a level of confidence in their performance already, either through their industry relationships or through their former companies. And so I would say, building that level of trust and seeing them execute is something that definitely helps get them over the final edges of a very competitive process for our investing. And the other, I would say, green flags, so to speak, are if we spend a lot of time looking again at the customer references, but also the financial trajectory. That two of the three partners, the financial implications of the decisions that they've made thus far, how they've structured, their labor model, their unit economics, their growth, and the investments that the investors that they've taken on so far are all really important for us to look at. So it's less about compared compared to other firms, I would say it's less about just having a good feeling about the founder, but really looking analytically at their trajectory, and their data, and their technology, and doing those customer references. Yeah,
Yeah, very few things beat firsthand experience of witnessing someone go through the churn.
it's yes, it's
I would say for us, it's any number of things that together kind of create that magic, but a couple things time and time again do show up. I think the first is somebody who wants to and believes that they can build a really big business. We fall into this trap sometimes where we'll see something really interesting and we all have these ideas about how this could be a $300 million business, a $400 million business, but if the founder themselves cannot articulate that to you, it's no use for any investor to have that kind of story because ultimately you're not the operator. You need the founder of the business to want to build something super big, just as a starting point, I would say, and to have that vision for the company. That's one. The second is the ability to continuously learn, and continuously up level because it's this really strange thing where, like in every other business, you kind of expect someone to take the next role when they've already been doing a little bit of that before. But if you're the CEO of a high growth startup, you're basically asking somebody to do like when they're at $1 or $2 million to be a phenomenal salesperson, and when they're $50 million to be like a really good middle manager and organizational head. And then at a $400 million company, they're meant to be like IPO ready and talking to investors and doing all of these compliance meetings. Like it's a vastly different job year over year. So somebody who's able to learn really quickly and who wants to be in a different role, I guess, every single year, um, is also important. And then the last thing I'll say on the sort of intangible qualities point is someone who is able to articulate what their business does and the value that they add. Super, super clear. And that is more important, I would say, in a climate tech business than it is in some of the other sectors that we invest in because it's not the kind of thing that's immediately understandable to most people. I mean, like him, we mostly only invest in B2B and B2G companies. And so that's not the same as selling like a consumer product that, is really easy to grasp. If you are building something that is deeply technical, and by that I don't mean like a deep tech hardware product, but it's anything that's complicated, driven by a lot of regulatory features, just something that isn't easy to understand, you need a CEO who is really able to speak to that well, because again, no amount of investors or like advisors or other operators doing it on their behalf can really overcome that hurdle of not being able to sell the product well, first and foremost, both to other investors and to potential customers.
And I would add, in addition to the importance of that external communication, also internal communication. Are they frequently updating the board, utilizing, how are they speaking with the rest of their team? What is their cadence of updates? Do they leverage the board when needed, and are they honest in, some of their challenges? So absolutely. How I think taking it a step back, communication more widely, right? Not just externally and for the sake of investors, but also internally is something we also take a look at.
Very insightful. I want to shift a little bit to the non-financial measures and metrics, because I know you both are passionate about impact investing in perhaps different ways, but could you shed a bit of light there? Whoever wants to start.
Oh, sure. I think it really depends on the business, honestly. Like because we invest in so many different sectors, and even within climate, we invest in so many subsectors that they're not necessarily comparable. But common things that come up might be just like CO2 emissions abated, for example. Sometimes that's direct, sometimes that's indirect because of kind of changes in supply chain, but emissions removed. Um, if it is in a food or ag company, it might be kind of pounds of waste,
Mm.
eliminated. If it's something that is more buildings focused, it might be like energy costs reduced, something like that. But we're usually trying to do two things. One is we're trying to measure, and I will say we do annual impact reports. It's something that, we put in our contracts with our CEOs and that we then report out to LPs. So it's something we do take very seriously. But we're looking for two things. One is that it's a metric that is core to the business itself. So it's not something that's like to the side and additive and is like not something the business would ever measure, but for the fact that one of their investors is asking them. That's one. The second is that hopefully it does have some kind of financial tie both to the customer and to the business itself. So for example, like the business that we invested in, that's a carbon removal business called Vaulted Deep, kind of tons of carbon removed is related to the revenue that they generate. And so that kind of tie is important because it means that your impact metrics are both central to the business and are indicators of the financial performance of the business. Because if it's kind of completely detached, then either to us it's not a real impact business or we're just measuring the wrong thing.
Gotcha.
We have a very impact-driven investment approach. We assess impact according to a pretty robust process that's separate from our financial analytics and underwriting of the companies. It also really depends, as Jill mentioned, not only on the sub-industry of climate, because they vary significantly, right? If you're looking at water, a water company, if you're looking at a food and ag company, if you're looking at a shipping emissions company, for example, these are all different parameters that you can put KPIs around and monitor over time. So we're careful about that. But I would say more generally, at the earlier stage, we're looking at the potential, the vision, and some of the early processes the founders have put in place. Generally, these companies are fundamentally solving a critical problem in one of these areas. So they have their own ideas of how to measure, and we work with them on that. But we expect in the early stage side, especially in the seed stage, not to be a burden for these companies. Obviously, if you're getting it's so difficult to be a founder of one of these companies to begin with if we're putting too high of a bar on the parameters and the reporting and the types of verification and analytics early. It's not in anyone's best interest to do so. So we grow with them as they scale and they get the appropriate resources. Obviously, on the growth stage, we really look at the actual performance hurdles. Generally, we've kind of broken down the three areas of how we approach looking at impact to be the vision, the equity. So we do have an equity meaning, DEI. While that is getting a lot of political pushback right now, that's something that's still really important to us. And then reach, which is kind of the scale and the depth, the degree to which that company can make a difference. And just to touch quickly on the equity element, two of the three partners, I'm female. One of my business partners is Black. And the three of us really believe from the ground up that having a team from different perspectives and different communities can add a lot of value, especially when you listen. And we also have seen firsthand that companies and founders that have, female or diverse or both representation generally don't have as good a value. I mean, as high of a value. And so that in and of itself is an opportunity. And quite frankly, looking at the data, a lot of times these companies do outperform and have a longer lifeline of those, especially those in the mission-driven space. So we do take that into consideration, and along with a pretty robust parameter, and then each partner, as well as the principal who's working on the deal, assess against a whole, in addition to the financial metrics, we assess across a number of these impact metrics. We rate it on a scale of 1 to 10, for example, and it's blind. We have to submit all of our analyses blind, and then we compare it. And that really, it's really interesting because we get to see the differences, having done our analysis separately on impact. And the differences are the areas that we like to focus on and talk about and really can bring light. And this anyway, so that speaks a little bit to our process.
I love it. Um, Rachel, how are we doing for questions? Do you have a few that we can get started with?
Uh, yes.
Okay, great. I'll
Um,
turn it to you.
Amazing. Lori, do you want to unmute and ask your first question? Lori
Thank you
Rosenthal?
very much. Yes. How do you go about finding a hidden problem? I just left a startup where the COO is going to sink the company, and the employees of the company are wondering where the heck the board is, where the investors are. Um, the CEO, for some reason, is blind to the COO, and so, we were wondering what kind of information are they getting. He's presenting illegal information. He is not managing customer relations well, and I left because I see no future with the company. How do you find those?
Yeah. Can I ask, that's such a good question, by the way. Do you mean before we invest or once we're already in the company? Because it could be
Well,
both.
I joined them between Series A and Series B, and so they went to market for Series B. I mean, and I was the VP of HR, and it was like nobody came to me to talk about how they deal with customers, how they deal with employees. So they were looking for major investors, a lead investor, and the current board. It's like, isn't anybody watching?
Yeah. Um, I can start.
Go ahead.
It's one of the hardest things to find out actually what people are not telling you, and one of the key points of diligence, I would say. When we invest, like the first meeting is almost always with just the CEO, then it's CEO and co-founder, and then we will pick other executives, and it's usually the rest of the C-suite and the executive team, usually the head of sales, head of finance. We, I would say about half the time, like Series B companies don't even have a head of HR or VP of HR, but if that position exists, then we will try to talk to the executive team. It usually totals probably like 3 or 4 executives for each company, and we do those one-on-one, like without the CEO present. And what we're looking to do at that point is basically to surface those issues. So people in a fundraising process, I think, are pretty reluctant to openly say that something is wrong because, of course, it's not in anyone's interest really to do that. And so we'll ask things like, who is the most important person on the team? Who do you work the most with? Who could you not do your job without? And kind of circle around to figure out who are the critical pieces of the puzzle and who are the people who are kind of holding back the company. Um, and usually there's a certain way to phrase a question, and it's really hard for me to do it live because it takes a lot of thinking. But usually when you ask people questions, not that are not meant to accuse them of doing anything wrong, but to help them be more successful in the future, I would say they tend to be more open about ways in which they're being roadblocked internally. Um, that is sort of the human aspect of it, the kind of, I guess, like verbal and softer parts of it. We also just do a bunch of things around, we'll like look at every customer contract, we'll ask for financials if they're audited financials, to get those as well. And what we're trying to do is like find the actual legal basis for all the numbers and all of the things that the executive team has said exist. And if there are discrepancies in those, I would say that that is an immediate red flag. So, both in terms of interviewing the exec team, doing just other references on people that are not necessarily provided by the company, but that we have through other mutual connections, and trying to kind of match every single statement that's been said by the founding team with, a legal basis. In fact, I would say that's how we try to find things. I would never pretend that we've caught every mistake or that, it's possible to kind of to unsurface every single hidden problem, but that's what we try to do.
Um,
Just
Go ahead.
sorry, Kim, we have a few more questions and I want to make sure everyone is heard. So if it's all right, Monica, do you want to unmute and ask your question?
Sure. Yeah, great. Nice to meet everyone. I was just curious if there were any portfolio companies that you're excited about right now, like any case studies, or recent investments for companies that you believe will be able to weather, the coming storms, both politically and from a market perspective. And yeah, anything you're doing to help them prep for that.
Maybe you should go ahead.
Um, yes, I mean, I think there's so much to unpack in that multi-part question, but of course, we're incredibly excited about a number of our portfolio companies. A number of them, even though they have contracts with the government as well, like Department of Defense, for example, they're pretty much well situated in reframing their value add to be an efficiency play or an information play, or to be at the front lines of a more kind of advanced manufacturing and technology, driven, I would say, thesis where separate from any reliance on, subsidies or government contracts or anything like that, they're in a really good place to succeed. And so I mean, I think if what you're getting at is how do these companies weather the storm that we're really excited in, obviously it depends completely on the type of industry that you're working on, but I do think a number of them are going to be really affected if they were relying on a lot of external capital coming in right now. But for those that are kind of past the point and they are close to positive EBITDA and growth, and they're already showing unit economics in terms of efficiencies, or I think that they'll continue to succeed and scale, and some of the deregulation may actually help them.
And Monica, Monica, I think you had, you already asked that. Sonu, would you like to unmute to ask your question?
Yeah, but firstly, just thank you so much. I'll quickly ask my question and then, so I work in the regenerative agriculture space, and I'm wondering what your experience has been in this sector in terms of either technologies or even supporting funds. Yeah.
The breadth of technologies in agriculture and regenerative agriculture.
Yes. Your experience or whatever you've come across in this space.
Oh God, there's so much. It's really exciting. It's hard to answer quickly, but we've looked at everything from crop engineering to soil health to new ways to make clean ways to make fertilizer, higher monitoring and growth of the plants, better, upcycling of crop waste, for example, into other products. New uses, material science, new financing structures and insurance structures for farmers. I mean, it is so vast. Supply chain AI and intelligence. There's really a lot. Coatings to keep the prolonged life of produce, and or atmospheric monitoring for our food systems. For example, temperature controls and all of that. So, I mean, it's really vast.
Music to my ears. Jill, any of
I'll just quickly plug one of our companies that's in this space. It's called Regrow Ag, and they help organizations with better visibility into their supply chain, and helps organizations transition their suppliers to regenerative ag practices. Doing super well, just raised around, wanted to mention that in the agriculture space.
Thank you so much for answering that. But what I really found interesting during our own session, the session that we just had, Kim, your point on code switching, because carbon is, I'm located in Canada, and carbon has become a dirty word here, especially among the farming communities. So to be able to position that as efficiency, that's something that we are actively doing. And Jill, you talked about, core to business impact metrics. And so thank you so much for the nudge there, because even though carbon markets aren't here, biodiversity credits are not here, we're trying to tie this back to the input saved, the costs saved to the farmer. So really trying to tie that down to the finance metrics. But just as background, I'm trying to set up a fund called Soil Bank in Canada. And this will invest in farmers directly. So a lot of risk there, but quite in the early stages of figuring this out. So it's been amazing. Thank you.
Thank you, Sonu. I want to do a time check. It is top of the hour. Kim and Jill, do you have time for one more question? If not, we can wrap it up and we'll follow up with the session.
Yeah, I'm okay.
One more question? Okay, Rachel, one more question.
Well, Monica had actually asked a follow-up question, and I'll just say it quick, Monica. If there's any portfolio companies that are generating meaningful revenue or cost advantages with AI right now, if you could give some examples that you find to be really, really eye-opening.
I'm happy to take that. We see more and more applications, and it's just incredibly exciting in pretty much every industry right now. One of the ones I'll speak about as a very clear example of how AI is adding value right now. We have a company that is basically an intelligence for shipping companies that build digital twins and use AI on top of all the data that they create from the engine systems of ships. They put a whole bunch of off-the-shelf sensors, very cheap sensors, and tie them into the flume stacks of these ships and are able to measure multiple different types of gases and the combinations of those gases. Where the AI comes in is by analyzing the data of these ships can go the same route at the same amount of time and cut fuel consumption, in some cases by up to 40%. And you ask how you do that, and honestly, the engine is something that hasn't been redeveloped for, hundreds of years, and especially for the shipping industry. These are giant fuel burning, oil consuming engines that if you can just make them a little bit more efficient or turn them off when they're not needed or run them differently, and change the inputs to maximize the outputs, change the routes just slightly, you actually can have a huge difference on emissions, and that saves this company that I'm talking about called Sail Plan that just came out of stealth. We've introduced them to the head of Disney Cruise Lines, who's now joined the board, full fleet deployment across all their ships. And it's one of the hardest companies to get into, but they had been looking for a solution in this in a long time, and the data hadn't been good. The quality of the data that the AI is running on is really important, and it's been able to save each ship $6 to $8 million just by running the numbers more accurately. And then Disney doesn't have to overpay for their sustainable fuel overcompensations. So it saves them money from day one. So that's like just one of, my goodness, so many exciting examples.
Yeah, I would say, just to quickly add on to that, I think the theme of using AI to basically improve the way you make decisions and thereby increase revenue and cost is a big theme. So the company I mentioned before, Regrow, does this by helping organizations evaluate every supplier, every crop, every kind of finance input, crunches all that data together, and then figures out what is the kind of most cost-effective way to reduce emissions across the supply chain. That's one. There's another company that I can't say the name of yet because we're actually currently in the process of closing, but basically does this in the buildings in real estate space and helps to prioritize the best CapEx investments to make that will directly improve the bottom line. So reduce energy cost, increase income, and therefore increase the value of a building and a portfolio of buildings.
Very cool. Very cool. Well, just to wrap up, thank you, Jill and Kim, so much for joining us and sharing your experiences. We love these chats because they are more open, I believe. And both of you are such a pioneer in your space. Kim, just your courage, but also your ingenuity, your creativity on building your ventures, and then Jill, your ability to pivot and learn things like tax structures and different types of investments, and how passionate you both are about your portfolio companies. I'm truly excited for our industry and the world because of you two and so many similar investors like you both. So thank you for spending time with us, and we hope to chat soon.
That's so sweet.
So much
Thank
for
you.
hosting us.
Thank you.
Thank you,
so much.
Rachel. Thank you,
Bye.
everyone.
Bye.
Bye.